This hidden retirement risk can cut years off your nest egg, even if the market averages great returns. While long-term market averages might look smooth, the actual path of returns is what could make or break your retirement. Here's why. If you have to sell growth investments during a period of market downturn while you're withdrawing money, especially if it's early in your retirement cycle, you are permanently reducing what's left in your portfolio that could recover as markets improve. Two retirees can experience the same exact average return over a 25-year retirement cycle, but if one person has steep losses early in their retirement, they might run out of money a decade sooner. This is why I help clients implement a two-part strategy. First, we use what's called a bucket approach. The first bucket, we look to identify how much do you expect to spend or withdraw from your savings over the next 5 years. We want to intentionally earmark that amount of money in an investment structure that is not taking on high levels of volatility. You're prioritizing capital preservation over growth because you know this is where I'm going to take my savings from over the next 5 years. You can sleep at night knowing if the market does have a downturn, I'm not going to have to sell my growth assets at a really crummy price. I have a plan of where I'm going to take my money from to meet my expense needs. The second bucket is the growth bucket. What belongs in the growth bucket is everything that's not in the first bucket. This bucket is primarily invested in stock. You should expect higher levels of volatility, but you're also planning for higher long-term average rates of return. The growth bucket is essential to help you solve two big risks. One is longevity risk. You might be retired for 30 or 40 years. And two is inflation risk. We have to have a basket that's going to keep pace with inflation over time and also grow enough to make sure that you don't run out of money if you live into your 90s. The idea of being retired and still having money in a growth bucket might be anxiety-inducing. You have to think about the risks I just mentioned around inflation and longevity, and you can sleep at night knowing that if the market does take a dive, you have enough money in a safe and secure place in the first bucket that you will draw on that you won't have to take out of the second bucket as it's recovering. Having the short-term bucket and the long-term growth bucket ensures that you have enough money in a safe and stable place to help you ride out any market downturns. But it also means you have enough money in growth assets that'll help you reduce longevity and inflation risk over time. Second, we pair the bucket strategy with an income guardrail strategy. We start off by saying you can take a 5% distribution rate. That's 25% more than the average retiree who's using the 4% rule. We establish an upper guardrail and a lower guardrail. The lower guardrail is key. If your portfolio declines below that lower guardrail, because of declining market environments, you have a proactive plan to respond to that. You would want to take a temporary reduction in distribution by 10%, but it's only temporary. Eventually, when the market recovers, you'll bring your distribution back to what it was before the market declined. The reverse is also true. If your portfolio exceeds the upper guardrail, this is how you can give yourself a raise in retirement. Pairing the guardrail's income strategy with the bucket's investment strategy allows you to optimize for retirement fulfillment while also making sure that you will have plenty of money left over at the end. If you don't have a plan to manage the sequence of return risk, schedule a call with me using the link in my bio.